Hey everyone, so thanks for joining us today. Today's session is going to be about the basics of fundraising from the point of view of founders. So this is, I guess, the culmination of all the things I've learned over the last, I'd say, 3.5 years working with, at this point, probably over 50 VC funds or firms, and hundreds of individual investors, and I guess thousands of people from a sort of decentralized speculative community. These are all the things, I mean, frankly, this conversation could go on for probably 3 or 4 hours. So I tried to distill down everything that I think would have been useful to know for myself, say 3.5 years ago, that I can now pass on to you guys. But ultimately, there's just too much to say here for 1 hour. So if you have questions afterwards, I would love to continue the conversation. And you can always reach out to me on the Discord server if you have questions as a founder. So with that, let's get into it. Let's share my screen. Okay. If someone could give me a heads up that they can see this, that'd be great. I guess Marina's gone from the screen, from the stage. Let's check chat. Optimal. Okay, great. All right, so I've split this into sort of 4 stages. The first is like the basics. So as a founder in the ecosystem, if you're building a profit sharing community, what are the steps you actually have to go through in order to successfully raise money to build out your application or whatever it happens to be that you want to achieve with the money that you're raising? I've also added a section on sort of the raw basic realities of what it's like to actually run an organization or build an organization which is VC-backed or in some sense backed by external investors. I think this is something that's not very well talked about in the whole startup ecosystem as well as in the crypto space. So I'm going to try and give you like the raw realities of the situation. As well as some misunderstandings that founders commonly have when they're going about the fundraising process, either getting started or afterwards, like the unrealities that people have in their dreams when they start these things that aren't actually real. And then some basic tips. And this is a section that could really just go on kind of forever, actually. There's just so much to say. But I've tried to distill it down to the most important stuff first. Okay, all right, so cool. You've built a profit-sharing community of some kind, and you want to raise some money to get to the next stage. Well, the first thing you've got to do is you've got to set a smart raising target. So this is a theme that you'll see repeatedly in this presentation. You should not try and raise too much money. What you want to do is you want to work out how much money do I need to get from the current place that I'm at to the next, the next level, where my valuation, I think, will be much higher. So from the point of view of the founder, what you want to be doing here is you want to optimize for owning as much of the asset and the thing that you're creating as possible when the thing becomes successful. And the way to do that is to make sure that you have enough money to get to the next stage, where the valuation will be substantially higher before you need to raise again. But not much more than that, right? You don't want to raise too much money because you'll be giving away too much of the thing that you're building up front. So that's a very important starting place. And also something that I don't think is well understood in the industry. So don't just raise $1 million, $8 million, $10 million, whatever it is. Work out what it is that you need and then go about raising that money. Valuation, in general, you can, debate with the market. So you'll speak to a lot of different investors, and over time you'll get a feeling for what kind of valuation is acceptable to the market. And that's fine. But what you need to know up front is how much you need to raise in order to get to the next stage. Get your cap table right. So you've spoken to some investors, or let's say down the line you've spoken to some investors. The first thing that people will want to know is, what is the cap table? Like, once they get past the point where they realize that your project is very exciting, you as a team, you seem capable of executing what it is you're trying to build. Now they want to know about the raw fundamentals, the economics of the of the thing that you're building, of the opportunity from their point of view. And so how you do that is you make sure that you have a robust cap table. What you really want to go for is something that basically doesn't raise any eyebrows. This is the kind of stage when an investor asks you for this, that you just basically want it to look fine. You don't want it to look out of the ordinary. And one really good way of making sure that your cap table is, say, acceptable to the market is to speak to other founders, profit-sharing community founders that have already successfully raised, and there are already quite a few of those in the ecosystem now. And just get their advice. Hey, does this cap table look kind of okay to you? You can also Google, like, what are the token distributions for other large projects in the crypto space? One thing that a good kind of template you could say is Ethereum, right? So Ethereum had about 18% of the tokens for the team and for the founders. And then I think it was like 12%, something like that, for the organization, and they sold a bunch more. And you can just look at this from a historical perspective, like what have other founders done successfully, and just try and calibrate your offering so that it's reasonable for the market. One thing that you should be aware of is that when you have tokens that can be distributed for mining or essentially community adoption rewards, in the case of a profit-sharing community and a PermaWeb application, then you've got to understand that those tokens that you're putting aside are essentially marketing budget. You can use those tokens, and those tokens will rise in value as your project gets adoption. You can use those tokens to incentivize people to adopt your platform. It's very effective, but you need to make sure that you have enough tokens set aside for that. But don't think of it like you're giving them away for free. That's not the case at all. It's marketing budget. It's, very, very different way of looking at it. So, okay, you know how much you want to raise. You know an approximate overview of what your cap table should look like. And you've kind of calibrated it with the market, and you said, hey, does this look about right to you guys? They say yes. You say, okay, great. Next thing you need is to get your materials in order. So some of the PermaWeb projects in the ecosystem, depending on what the service is, so for example, if it's a consumer-facing service, they'll have amazing websites up front. So that's great. But others that are more infrastructure-focused, for example, can be at the point where they have real users and a working system, but actually their, public-facing appearance just isn't right. And you need to fix that up before you start the fundraising process, because people will judge you and the quality of your project based on your public appearance, regardless of what you have going on the back end. So make sure you get that right. Obvious part of this, make sure you set up email addresses that are associated with your new project. You've got to become real, and part of the process of becoming a real thing is obviously making sure that you have the appropriate infrastructure like that. So make sure you have founder email addresses. Make sure that the public website looks good. And critically, prepare your documentation. So, okay, yes, we're starting decentralized organizations and essentially networks, depending on the structure of the community you're building. But the reality of the situation from a regulatory point of view that we live in now is that you should probably be doing this under the protection of a limited liability company of some sort. Yes, so you need to form your company that's going to issue the tokens, and you need to get legal advice, or at least get access to docs that you can use for the fundraising process. There are quite a few different docs going around the Arweave ecosystem now, so you can just ask other founders to get access to those as well. I'm sure they'll give them to you. But you should also just understand your sort of legal and compliance obligations. And of course, form your company. You should not be doing any business dealings before you have a company formed that's going to sell the tokens. Otherwise, you're selling them yourself, and you're exposing them yourself to potentially greater legal liability. That is why we have limited liability companies after all. So make sure you have your docs in order, make sure you have your company formed, and so on. Okay, great. So you've got everything in order on the back end. You've got a company formed, you've got a good project, a good product. I mean, I'm just taking it for granted here that you've built like an MVP of your system and it's out there in the world. That's like all of the other talks in the Open Web Fellowship program kind of talk about how you can get to that point. This is really just talking about the fundraising process. So you've got your product, you've got your company, You've got your docs and your sort of infrastructure set up. So you're becoming real, if you like. Now you need to, and you have your cap table prepared. Now you need to approach your first investors. This is sometimes, if you're not connected to the right people, this can be one of the hardest leaps in the whole game. Because the quality of investor that you reach in the game that will follow, and I'll tell you about that in a moment, will be dependent on the first people that you get into the ecosystem with. Fortunately, if you're building a profit sharing community on Arweave, we, the Arweave organization, already know of I think dozens of investors at this point that have indicated a strong desire to invest in the space. So that's great. If you reach out to us, we can probably put you in touch with your first investors that might like to speak to you. Okay, so you get your first meeting set up. You've got to gain your first soft commitments. And we'll talk about how those conversations, essentially pitches, will go with the investors a bit later in the talk. But broadly speaking, you're going to get on the phone and they're going to ask you to explain what it is that you're building. And you're going to just kind of, sell it to them, just like you would a user or like you would another potential co-founder, or maybe even just someone that might work for you in your organization. Just sell them on why the thing is exciting. And then you'll likely find that maybe after the first one, maybe after the third one, someone will say, yeah, that sounds interesting. I might be interested to put in, say, X dollars into this. Okay, cool. So you've got your first soft commitments. That's great. Now you need to start a spreadsheet. This is very basic, but this is the process. You need to start a spreadsheet and you need to track who it was that you spoke to, how much it was that they offered, and don't say yes or no definitively yet. We'll come back to that phase later. You say, okay, thanks, really appreciate the offer. It sounds very exciting to work with you or what have you. Let me get back to you once the round is coming together a little bit more. Then the critical thing is explore the social graph. So from your first soft commitments, you want to ask, hey, do you happen to know anyone else that might be interested in this, by the way? And then you meet those investors' friends. And if you already like that investor, they're going to introduce you to other investors that you're highly likely to like too. And from here, you just basically play the same game over and over and over again. You just explore the social graph of the investor space more and more until you reach the cap. So great. You now have offers exceeding the amount of money that you want to raise. Amazing. The next thing you want to do is you want to start critically analyzing the offers you received and the investors you've received them from, and deciding who you'd like to actually make allocations to. So at this point, it might be tempting as the founder to be like, okay, I'm done. I have reached the cap. I shall now go and close the round. But what you probably want to do instead is actually just explore the graph a little bit more. And what you'll find is that because you've already got commitments exceeding the cap that you're trying to raise, it will actually be quite a lot easier to get people to commit to coming into the round. So it's worth it at the end to put in some more time to see that, to make sure essentially that you've got the right investors in the fundraising round. And this is something that is going to come up over and over again in this talk, I think. You really want to make sure that you are picking the right investors. It is everything. It's absolutely everything to your experience as a founder building this thing and the likely success of your project. The wrong investors can do a huge amount of damage. So just bear it in mind. And considering that this is something you're essentially committing your life to building, it's just exceptionally important. Okay, so imagine you're sitting in front of your computer, you've got the spreadsheet, and okay, you've noticed basically now the to-go summation is negative. Brilliant. So what do? Well, you look at the investors on the list and you critically analyze your conversations with that person. How likely do you think that person is to be successful to your project? Did they say anything that might make you concerned that they might actually cause you more problems down the line? And then you essentially want to allocate more capital in the round, so more of an allocation, a larger allocation, to the backers that you think are more likely to provide you with essentially a positive sum effect on the project, as well as the capital, rather than negative. And then you just make, and you should also be thinking about this from the point of view of you can also just offer a very, very small allocation or even potentially drop people from the round that you're not comfortable with working with. This is not stuff you hear often in the startup space. Like, everybody sees VC as this glamorous thing almost, but you as the founder, the reality of the situation, which we'll get to in a little while, the reality of the situation is you want to be very, very critically aware of who it is you're giving larger allocations to in the round. And larger allocations are really you agreeing to a long-term relationship with that person where a lot of capital is going to be on the line. Like, both at the beginning, so the larger the allocation they give you, the more of a bet it is from their point of view. And also later, once your thing rises in value substantially, now, from your point of view, they hold a huge number of, a huge amount of value in your project, which is something you really want to understand. So be critical about this. Think very, very carefully when you make your allocations in the round. Okay, fine. So you've got a table and you've rejigged potentially the allocations until you're comfortable with them. You think this is the way to go. Now, you start with the people that are most important to the round, so probably the largest holders, or the people that are most, socially important to the structure of the round that you're building, and you check with them. You email them, you message them on Telegram, you say, hey, I've just made a draft of the final allocations for the round. I've got you down for X amount, and remember to go through the other terms, like, is there a lockup, for example? Just checking that that's okay with you. They say yes, then great. You go to the next person and all the way through your cap table until everybody is confirmed. If you reach a snag and someone says, actually, no, I don't want to put in that much, or I want to put in much more and I'm not willing to go for less than that, then you might need to reorganize things again. And this is why you make sure to go from the most important people to the structure of the round to the people that you think are going to be easier to get to essentially confirm what it is you're asking from them. Okay, great. You confirm the commitments. You send the docs. This is pretty basic. Hopefully you will have received the documents from someone else in the ecosystem that they're using for their routes. And remember, at this point you absolutely must have your organization, whether that be a company. Most of the structures in the Arweave ecosystem have been companies so far, but it's also possible that you could use a foundation, and your documents. Ideally, you also receive those from another founder and you've had them looked over by some kind of legal counsel, or you, through other means, have decided that you're comfortable with the deals that you're making. In broad structure, these should typically be in the profit-sharing community space before sufficient decentralization is reached. There should probably be a private sale agreement to only accredited investors, and probably with some form of lockup. That looks, we are not your lawyer, for sure, and we are also not lawyers at all. But that, to us, looks like the emerging best practice in the ecosystem until such a point where sufficient decentralization of the technical side of the project has been reached. Okay, get yourself a DocuSign account, or maybe use Credence, the Arweave-based DocuSign alternative, which is, I think, nearly ready. However you're going to do it, send people the documents to sign. Most people will look it over for a couple of days, some people less, some people longer. It's actually a good thing in general if the investor spends more time reading the docs. It's actually a positive sign. They're being serious about what it is they're getting into. Yes, then they will send you money and you get back to shipping. This is pretty much the basic process, start to finish. Now, some realities of the situation. Big numbers are bad. We read in TechCrunch or on Hacker News or in the crypto press, X project raised X large amount of money or Y large amount of money, and it looks very impressive, right? It's like, oh wow, they must be a serious thing. But this is not smart. You only want to take the capital that you need to get to the next stage. Otherwise, you're going to raise a too high a valuation. The money is going to come with strings attached. So it's going to potentially make your investor relations burden higher, and the expectation to ship something incredible way higher, and potentially more so than you can actually deliver on. And also, you might just end up wasting other people's money. So you're going to give away too much and the outcomes are going to be worse. Whereas actually, if you're the founder, you just want to give away as little as possible so that you can get to the next stage while maintaining as much ownership of the thing that you're building as you possibly can. And you can think about it the other way. Like, even if you were maliciously not really, convinced on the success of the thing, and you're just trying to arbitrarily raise large amounts of money for it, which unfortunately was the case in the space back in 2017, it's actually not helpful. Like, as a founder, if you're going to fail, then having more money is unlikely to help you, but it might prolong the investment of your entire life into something that isn't working. So you just want to have this relationship where you're taking small amounts of capital as needed and keeping hold of much of the ownership of the thing as you possibly can for later. It will mean that you have, in the case where things go well and you succeed, you will own more of the thing that you have created. That's what you want. That's the good outcome for founders. And in the case where you fail, you will have wasted less of other people's money, and you'll get to that point earlier. It's just better for everyone. Big numbers look good, but are bad in practice. Post-fundraising, you should expect to spend 25 to 35% of your time in investor relations. So you best make sure that you like these people. Like, really. As the founder of the project, you might have got into this from a purely technical point of view. You like building this thing. But now you've got to face the reality that your job has partially become just investor relations. So you've got to really choose that investor set extremely well to make sure that you like working with them, frankly, and that you think that they can be an effective addition to your team. It's got to be something that you wake up in the morning and you're just excited to get going with this thing. No doubt there are going to be hard times, but you don't want those hard times to come from the added investor relations burden. And I think if you speak to a lot of, people don't say this in public very often, but if you speak to a lot of founders behind closed doors, say, and you get their opinion on what the fundraising process has been like, they will tell you that they just are not fans of this whole component of the job. And part of that comes down to having picked the wrong investors. So don't do it. Make sure you have the right investors and you're comfortable spending a lot of your time talking to them. And you think that they're going to add value to your project to make it more likely to succeed rather than less likely, which is surprisingly hard sometimes, actually. Okay, and one of the extra reasons for that is often investors act as quasi-business development staff whom you sort of owe because they have betted on you succeeding and you cannot fire. So you really need to make sure that you think that they're going to represent you well to the outside world. Otherwise, they can potentially screw up your project and you can't really stop them. And you also have to, You have to invest significant amount of time in sort of servicing their wishes, doing the things that they think are important. And this can be an absolute disaster sometimes. It'll waste a lot of your time and a lot of other people's times too. One of the adverse effects that can arise in the founder-investor relationship is, so what you want at all time to do is maintain sort of aligned incentives where you're both shooting for the same thing. It doesn't necessarily mean that you're going to agree about how to get there all the time, but at least you both want to be shooting for the same goal. One of the ways, and this is largely easy, right? You just make sure that they are long-term committed to the project, and we'll get to lockups in a while, which is the way that you achieve that. But one of the ways that even with lockups this can go wrong is what at Arweave we call the double shill or the triple shill or even the quad shill. This is, okay, so an investor is incentivized to promote your project, and that is great for the project. But also the investor is incentivized to promote other projects. And occasionally the idea comes along, and I would say around 50% of the time, maybe 35% of the time, it's a great boon, but a lot of the time it's actually quite negative. They come along and they think, oh, well, I've got an invested stake in this thing, and I've also got a vested stake in that thing. And wouldn't it be good if I can make both of the prices of these assets go up at once? And the way to do that is come up with some weird idea about how the two things can be interconnected. Now, sometimes this is amazing. This leads to a lot of fantastic partnerships in the space. and is very valuable to the business development of your project. But also there will be other times where people are incentivized, investors of yours are incentivized to push you to integrate with other projects that actually don't make that much sense, just to, in the worst case, just to have publicity about how the two projects are working together and have this be a quick pump of the token price of both sides, which obviously is great for the investor, but actually for you, just on one side here, not really that great, particularly, you're a founder, so you're long-term incentivized by the price of the token, not short-term. Yes, and this can just be a massive distraction, a huge distraction. So if you notice yourself being put in a double shill or even potentially triple shill or quad shill situation where an investor is just trying to tie random knots between different projects to make the token prices essentially, what do you say, pump for a short period of time, then you have to work out how to handle it. You should be transparent as to whether you think that the cooperation is actually valuable, and you should also be respectful of the other founder's time. So if they put you in touch with the founder and you're not completely convinced that this thing is actually a very good idea, it's just that you have this slight problem of misaligned incentives, then you should be respectful of the other founder's time and try and keep the call as quick and effective as possible. So let's just make sure that we get to the point where we both know whether this idea has any merit or not as fast as possible. This is one of the unfortunate side effects of, the sort of high liquidity crypto ecosystem sometimes. And we'll talk about that a little bit later. Yes, okay, so that's something to definitely watch out for. But of course, it can be very, very valuable. It's just, it can also go wrong. So again, there's another reason you want to be really sure you understand who it is that you're working for. We can talk about ways that you can try and, or working with rather, we can talk about ways that you can try and come to that conclusion in a little while. Okay, another thing that you should be very, very aware of as a founder is that sometimes your motivations might be partially non-economic. You want to build a thing because you love the thing, right? But that might mean that you want to make decisions sometimes that are not necessarily in the pure economic outcome, purely optimizing for the economic outcome of the project. But your investors, they report to limited partners who are expecting a return on the money that they've given. So even if the investor is sort of ideologically aligned with you on how things should go, they are economically incentivized and sort of pressured by the world around them to pressure you to make decisions that are purely economic. There will be founders listening to this, I expect, that actually should probably simply not raise external capital and try and bootstrap as much as possible in order to avoid this problem. If you are not economically motivated, you really need to make sure that you understand what you're doing when you introduce actors that have a heavy say about how the project's going to progress that are purely economically motivated. This is an important consideration. And it really comes back to sort of founder-investor alignment. You should make sure before you get working with anyone, even if they're super excited about the project, before you bring anyone into the project as a sort of core investor, that you really are both on the same page about like, how long is this thing going to take to build? What are the outcomes we're trying to achieve? And so on. So just be aware of that. And the final thing, I know a lot of that was very negative, but the final thing to understand is that the hard reality is that if you don't have access to other capital, investors in the space will lend you capital to build the things that you are most passionate about in life. It can completely change your existence. It can be extremely exciting. We live in an extraordinary period in history where people that are technologically minded, engineers essentially, can go out and they can fairly easily, relative to history, acquire capital to pursue those dreams. That's absolutely amazing. It cannot be understated. So we should also give that adequate credence, I would say. Give it proper thought. Without, I'm going to get back to some tips. Okay, so misunderstandings. Investors must deploy capital. They are not doing you a favor. This is one that is sometimes hard to understand if you don't come from a business background and you are a technology person. Yeah, sometimes I've noticed some founders, they come to the investment world for the first time and they think it's a sort of quasi-miracle. People are giving them capital and they think it's amazing and they think that they owe them a debt of gratitude and that these investors are doing them a favor. It's absolutely untrue. It's fundamentally untrue. The investors have seen that engineers and people that are building things are capable of producing great amounts of value, and they can capture some of that value early, by essentially lending it or giving it to you, and then in exchange for another asset of value that you have but is not quite so liquid. So they're not doing you a favor at all. They're doing this for economic reasons, and the earlier that you understand this and you adopt it into your mindset, the better. You should not be going around the world thinking that this is a favor people are doing to you. This is a hard economic relationship that you're building. It's very important that you understand that. In crypto, VC doesn't necessarily mean long-term. This is something so one of the things that's happening around us is that the venture capital space is sort of moving into crypto and has been doing since basically 2016. Very, very slowly, but it's starting to happen. And people are starting to adopt the VC name, venture capital name or association for their funds, but actually they're operating them much more like hedge funds. And hedge funds are, going to rapidly come in and out of positions. And one of the things that will happen to you as a founder in the ecosystem that's long-term focused is that you'll be put on the phone with people, often potentially references of other investors, and this is going to happen more if you haven't picked your investor set well. You're going to be put on the phone with people and they're going to be like, if they're being transparent, they'll say, we buy and sell tokens on like a weeks to months basis, or low number of years, like maybe up to a year. Or if they're not being honest about it, they pretend to be long-term to you so they can get access to the deal in order to flip the token quickly. And this was rampant in 2017, 2018 hype cycle. One simple way you can get around this is just, if they say they're long-term, just only sell them tokens with a lockup. And don't take a discount either. Like if they're truly long-term, why do they need a discount for proving that to you? They don't need a discount if they're serious about it. Because they're going to hold the tokens for longer than a year or whatever the lockup is anyway. I mean, a year I think is a reasonable amount of time. So that's the way to get around this. But don't just trust that people mean long-term when they say it. Verify. Okay, this is a slightly unpopular opinion in crypto, but I'm quite confident at this point that it's true. Speculators are not community. So there's this sort of euphemism that people use in the fundraising and the investment space in crypto for community, where really, ultimately, they just mean people that are speculating rampantly on the price of the token. Now, there's certainly a place for people buying and selling the token. They provide liquidity to the market, which is great because you might have a token where people want to hold it to use it and that kind of thing. So you do want liquidity for sure. And having speculators, essentially all investors are speculators to some extent. They are speculating on the price of the asset. And indeed, you as a founder could be argued to be a speculator. You, rather than selling it all up front, are speculating that the thing will be more valuable in the future. There's nothing wrong with it, but it should not be confused with community. Communities are groups of people that are contributing to a project. And what you will find is there are a lot of short-term crypto investors or speculators that will demand that they are part of the community, and they'll make demands of you. It's going to be difficult, but you should largely ignore these people. You should let them speculate and do what they like, but you should focus on the things that are going to cause long-term value, even if in the short term it makes people dislike you or shout loudly about it. But ultimately you'll win in the long run if you provide value to the community and to the ecosystem, the actual community, as well as the speculators. rather than pumping the token price in the short term or doing these kind of short-sighted activities to raise the token price. Most projects from 2017, 2018, they actually died, partially because of founder greed, and also partially because of community or speculator groups pressuring them to pump the token price in the short term, expending all of their resources, and then the token price goes up, and then of course it falls flat immediately after, it dumps. And then the project finds themselves with zero capital available to support the actual building of the project. And the community of speculators are already gone anyway, because once they pumped up the token price, they left at the peak. And another thing that you should be aware of about that is that investors will always come and go, right? And whenever they go, they're going to sell to someone else that is essentially investing at a higher price, potentially, if they're not selling to someone that's using the product. And that's where you want to get to eventually, but the reality of the situation is that's not going to happen in the early stages. So if they're selling to someone else that is speculating on the token price, then while they're happy and now they're gone, most likely from your supposed community, now there's another person that is expecting the token price to go even higher and will put even more pressure on you to make it go even higher. This is a game you cannot win. Seriously, you will not win this. How you win in the long term is you focus on the people that are contributing to your project, and you make sure that they're appropriately rewarded, and then the value of the project that you're creating is actually rising over the long rather than the short run. Okay, so those are kind of the basics, the realities, the misunderstandings that founders sometimes have. This is just a kind of unstructured list of valuable, I guess, mantras for founders in the ecosystem, which I'll just run through as fast as I can. So don't trust, enforce, use lockups for long-term investors. If someone tells you that they're a long-term investor, that's great, very exciting. Tell them that you're going to enforce it by a contract, and then see what happens. You'll see that maybe in the crypto space, up to 75% of the people that have told you are long-term will shy away from taking a real lockup. You don't want to work with those people. They're probably not in it for the long haul. Show passion for your project. This is pretty obvious, but when you're speaking to an investor, they want to see that you just love your project. And so don't shy away. Don't be don't be timid. Be yourself and just say transparently the truth of why you're excited about the thing that you're building. And then this will come across, and then the investor will become excited because they think that you are the person that is going to build this amazing thing. Because it's clear that when you wake up in the morning, you're going to be excited to even when it's difficult, you're going to be excited to create the thing. And then even when it's difficult, you're going to power through. So that's really, really important. Show that you understand your tokens are valuable. Demonstrate the scarcity. This is just one of those weird human dynamics. People are more excited about scarce things. So show that you understand that the tokens that you're selling are scarce. Even before you have commitments exceeding the round cap, show that, look, if there's no demand for it, then you're just going to sell fewer. And actually, that doesn't mean that you're willing to take worse terms or let investors that you're not excited about working with into the thing. You're just going to take less money and you're going to raise again a little bit in the future. So show that you know that what you're building is valuable. Demonstrate that first, and then the market will follow. So you must demonstrate that they have scarcity. A brief anecdote here. Back in the 2017-2018 cycle, Arweave was raising money, January to June time, 2018, or May time. And it was my job as the CEO of the company and as one of the co-founders of the network to try and raise money so that we could build it after the launch was done. And I went out and I told the same story about, look, we're building this amazing new thing. It does this and this and this. It has these features. It's going to have users from over here and over there and so on, over and over and over again. But actually the interest in the project or at least investing in it was fairly limited. And bearing in mind, this was back when the token price was probably a 10th or maybe even a 15th of its current price. There was very limited interest in buying any until we reached one tipping point one day where we finally had commitments for the round exceeding the cap. And at this moment, suddenly everything exploded. And now we had this amazing project that, like, the fundamentals were really great. And, you know, they were before we had commitments exceeding the cap 2. So nothing had changed there. But what had changed was the scarcity of the token. This was just, it defined everything. And we went from this point where I'd had to spend months and months and months trying to raise money and not really having that much interest from the market, to this moment where suddenly everyone in the world was interested. And I think in the end we were over $1.2, $1.3 billion oversubscribed on an $8 million round. That happened because of scarcity. Nothing on the fundamentals had changed. So it's in your interest as a founder to ensure that you understand the value and make sure that you are demonstrating that the assets are scarce. No one can have access to these unless you decide to sell them to them, at a minimum. And then, of course, once you have commitments exceeding the cap, then it's even more scarce. But demonstrate that scarcity up front. Don't be the person, like I was, who was just desperately trying to sell these tokens that related to this project that was really awesome, but I wasn't demonstrating any scarcity. That was a mistake. Please don't make it. You'll thank me later. Okay. Know how to start a conversation with a new investor. This is a really simple one, but it's also very important. When you get on the phone with a new investor, some founders, they kind of flounder around. They're like, how do I start this conversation? Well, it's actually really easy. There's one simple trick. You're going to go into that conversation, you're going to say, how are you? Nice to meet you. And they're going to say, I'm well, how are you? And you say, I'm great, I'm so excited about blah. Something that's just happened. Like you just stopped working on your project right before you got on the phone with them. What is it that you're working on? Like, why are you excited right now? Tell them about that. And then from that, you can branch out to the whole project and the thing that you're trying to build and show the vision and how everything fits in and what the current state is. And you're bringing the investor in the same way that you would bring a new employee or potentially a community member, like a contributor, into the ecosystem and getting them on board with, like, where are you on this journey? And then they get excited. Whereas if you don't, you can potentially be in this situation where this is like awkward silence and you have to say, so shall I tell you a bit about my project, I guess? It's very awkward, easily avoidable. Just jump into what's exciting right now. Okay, another important thing is when you're looking at taking an investor into a round, ask them for references from other founders. Don't just take their word for it. Verify. And they should do the same with you, potentially. Like, they'll ask other investors what they think about you. You should do the same for them. And if possible, you should identify some of the projects that they've invested in, that they haven't referred you to, and see if you can chat to them directly. Like, see if you can get an unbiased look at what this investor is like to work with in the real world. Remember that you're essentially, in the best case, you're recruiting people that are going to help you build this thing over a very long period of time. And they're going to act, in, again, the best case, as business development agents for you. They're going to be trying to build this thing alongside you, and they're going to be, demanding a bit of your time in return for that. And you're not going to be able to fire them, or really say very much about how you're not happy with the way that they're working. So you best understand whether they are going to fit well with you or not. And the best way that you can do that is ask other founders, tap into the founder network as soon as possible. This is really very, very valuable because all the other founders out there are dealing with all the same problems, and sometimes founders can get kind of siloed on their own, and they don't have those links with the others, and they're kind of in the dark about how the real game is being played, how the whole ecosystem is playing out. Once you make those links with the other founders as soon as possible, then you're going to be looped into a whole information network, which is going to help protect you and make your project successful. It's a very valuable thing to do. Okay, treat investors as the peers that they are. You are all working together to build this. I introduced a founder to an investor recently, and the founder started calling the person sir. Please don't do this. Again, they are not doing you a favor. They are not your master. You are working together to build a successful project and make both of you money. There's an economic reality to the fact that if you invest in good engineers and business development people building great projects, you are likely to see that asset increase in value. That is why this whole thing exists in the first place. You must understand that this is not a favor that is being given to you. You're actually giving something that is highly likely to be much more valuable to someone else at an early stage where it is less valuable, which is a privilege, frankly. It's not something that they're doing for you as a favor. Don't think like that. Yeah. Okay, final and maybe most important point for the whole fundraising process: always drive the agenda. Nobody else will do this for you. You need to make sure you understand what your plan is, and I've outlined at the beginning of this talk a kind of good basis that you can use to derive a plan for the fundraising process, and make sure you drive towards that conclusion at every step. Be the one that follows up if they don't. Make sure that you make it happen, because nobody else will. And we at Arweave, we can give you all of the advice that we can, and we can help you out with any questions that come up. But ultimately, it's got to be you that is driving this to a conclusion. And you need it to conclude. It needs to conclude with some kind of momentum. You need to get to that final stage where all the docs are being signed with momentum. Otherwise, it just kind of fades away and fizzles out. And the investors get interested in other things, because there are a million opportunities on their desk every day. You need to, while you have everyone's attention, you need to drive to a conclusion, sign the docs, collect the money, get building again, get shipping, and get people to use your product so that it becomes successful for both you and your new investors. Okay, thank you everyone. I hope that was helpful. That was 3.5 years of experience condensed into like, what, a few minutes.